Hey, how are you? Jody Garrett. I'm going to go through a closing disclosure with you here. This is just a sample and just a couple notes on some of the closing disclosure stuff, CD for short. You'll probably get one 7 days before you close. That usually is a preliminary CD that's not updated, not final. It will get updated. It's not up to us entirely to update it. We have to receive information from the seller side in order to do that. So we are on their time frame a little bit when it comes to getting you your exact cash to close. So if you have an interest in getting that done sooner, the best thing you can do is reach out to your paid attorney. You're going to pay an attorney on this, and they can reach out to the other side and ask them to do their homework faster and get their information over to the title companies so that we can get going on our CD for you. So let's run this down. This is a six-page doc. Let's do it really quickly so that you've got some context. So date issued is just that. The closing date you'd want to check, make sure that that is what you think it is. Disbursement, this is an Illinois loan, so the loan funds the same day it closes. In other states, that's not the case, but in Illinois it is. This will be the name of the title company, otherwise known as a settlement agent. The property address will be here. Confirm the sales price too. Your borrower's names should be here. These are the borrower's names. So if you're not on the loan, you're not a borrower, so you wouldn't be showing up here. You'll be elsewhere in the documents, but not here. You'll see the seller's name. You'll see the lender's name here. That'll either be Prosperity Home Mortgage, or if we're brokering it to another, that will be another. This is the loan information. We've got a 30-year purchase, fixed rate, conventional. If you're FHA or VA, these would be checked. The loan ID is right here. That usually matches the loan portal. I have no idea what the mic number is. It's not important. The loan amounts right here, and the interest rates right here, and the principal and interest combined. So not taxes, insurance, PMI, HOA, nothing like that. Just the loan is right here. You'll see that none of these things can increase after closing. That's good to know. This is less than a 20% down loan. So there's going to be PMI down here in a sec. Moving down the document, there's no prepayment penalties, meaning you can overpay your mortgage payment and be okay with and not receive a fee or penalty for it. And that there's no balloon payment. So there's not some huge number coming down the pike that's going to be due in 5 years. It's a 30-year fixed all the way out, 360 payments if you did nothing, and you'd be done with the loan. Projected payment section. So here's that principal and interest that matches up here, right? This is the same this is the same number. This is PMI. So PMI on this one was about 76. And you'll see it drops off after 10 years. If nothing is done with this loan, we'll see the estimated escrow. So that's a combination of taxes and insurance that's going into escrow. It gets broken down separately elsewhere, but this is the combined amount. This will be also how it shows up on an escrow for your mortgage statement later, as combined, not separated, combined. And this is the estimated payment for the first 10 years, and this is the estimated payment for the last 20 years. This number, so this is a single family purchase with no homeowner's assessment. So this number is just simply the taxes and insurance. But if there was an HOA on the property, you'd see it here combined, added to this number. So if there was a $300 HOA, for example, if you're buying a condo or a townhome, this would say $823.32 because it would be combined. But since there's no HOA in this one, it's just these two things match because there's no HOA. Also, you'll see that this one is escrowing for tax and insurance. That, of course, makes sense because when you put down less than 20%, you're required to escrow for both tax and insurance. So they didn't have a choice. In this case, though, it just confirms it. But both of them are being escrowed, meaning when you get a property tax bill in the mail, since you're escrowing for taxes and since you're escrowing for insurance, the tax part of it, you'll get a bill in the mail, but you don't have to take any action on it. Okay, it'll get paid for you automatically. The best thing that you could do is set a calendar reminder twice a year right before the bill is due to go and make sure that the county website shows that your mortgage company paid it. Okay, that's a good thing to do twice a year, every year that you escrow anyway. This is the bottom of page 1. Closing costs are here. Remember, that's a combined amount, and we'll break that down on page 2. This is not what you're being charged on the mortgage. These are just your combined total closing costs from every which way, and we'll get that explained on page 2. This is the number that we're concerned about. That's your wire number. That's your cashier's check number. You do not add these two numbers together. Okay, this is separated out from this. So this is the number. So if this is my closing, I would be telling somebody you should wire about $42,000, or you should send about $42,000 on a cashier's check made to the title company. This company, right? That's right up here. Okay, and you always want to put a little padding on this number. Because sometimes things happen, things get updated afterwards, and sometimes that number goes up, and you don't want to be short at closing because there's not an easy remedy for it. Okay, so this is page 2, and this breaks down this number, this 11,000 number. Okay, so in this case, this is section A, and these are the lender costs in section A. You'll see we have an origination fee of $12.49. This is actually $13.49 now. It'll probably go up in the future. It's one of those. It's one of those fees that generally don't go down. That's meant to pay the staff at the mortgage company that have salaries, that have fixed salaries, and that's what an origination fee is. Almost like a bank's ATM fee. If you have a buy down, like if you have a temporary buy down or even a permanent buy down, this is where it's going to show up. That number would be pretty high. You can also have points in your loan, but it probably impacted the interest rate to get you a lower interest rate. Okay, so not a big deal. That should be there though, and it's not going to show up anywhere else but there. So that's section A. Okay, those are true costs. These are true costs out of this closing cost box. Okay, section B is all of the title fees plus the appraisal, credit, flood cert, MERS. And if there was a rush fee, in this case, there was for the appraisal, and then tax service 75. So all of these things, including this tech fee, it's not a junk fee that goes to someplace else. These are all the things that our mortgage company does not participate in terms of fees. So these are truly third-party costs. Okay, the title company fees all came from the seller side. So all these things together, plus these, equal this number. So $4,400 rounding up on a $440,000 purchase, probably pretty average, maybe a little bit high in the title fees, but for the most part, pretty average. Anywhere between $3,000 and $5,000 is going to be what title fees are for a buyer. Okay, here's the section C, and then here is section D, which is just a summation of A plus B plus C. So in C, there were no services that the borrower could shop for. They were all ones that they couldn't shop for. Okay, so that's why this is showing up here. So that's this figure here combined. Okay, so in the second part, in other costs, these are also transactional fees, except for sections F and G. So let's go into this in a second. In section E, we've got the recording fees for the county. This may or may not be updated yet, but it probably is. So this is a DuPage County closing. So this is a pretty typical fee for a buyer. You'll notice that in this particular city, this is the seller column. Okay, the seller's got fees to pay to the county too, but not the buyer. In some cities, they charge the buyer to move to the city. Addison, Illinois is one of those where it's like, welcome to Addison. Here's your bill for moving to Addison. Yeah, I mean, I like Addison, but maybe rethink that. So anyway, that's section E, true costs. Section F is where your homeowner's insurance for the year is going to get paid. This is usually going to be $1,800, anywhere between $1,200, $1,800, depending on what you're insuring. And then you'll always see prepaid interest as well. So prepaid interest is for the mortgage itself, whatever the day of to the end of closing, you have to pay that to the bank. So the bank doesn't skip any days of interest, and that's what that is. So that's why you see a lot of mortgages closed at the end of the month, because there's only one day of interest that gets paid. Not a big deal, but that's why that is there. That's from closing day till the end of the month. So this one closed on February 21st, and that's all the interest for that rest of the month. Okay, and then In section G, you'll see the escrow for insurance that's going in, and then you'll see the escrow for taxes that's going in. 3 months plus 12 months is typical for homeowners insurance. You pay 12 months up front plus a 3-month cushion. Okay, that's in case the policy premium goes up. There's 3 months of escrow that's always going to be put into a homeowners insurance escrow account. For the property taxes, it's 2 months. So it's 5 to pay the bill plus a 2-month cushion. So 6 to pay the bill, excuse me, plus a 2-month cushion. So 2 months for property taxes, 3 months for insurance. That's again in case property taxes go up during the course of the year. It's not immediately updated. There's an escrow analysis that gets done at the end of the year, so it's not all real time. So just be aware of that, because they take a 2-month cushion to make sure that they don't run out of money to pay your tax bill, but sometimes they will if the taxes accelerate too hard upwards. Okay, they might come back to you and say, we need to adjust your mortgage payment by a little bit to catch up on the escrows because we covered you on the front end, but now we got to make up for it with you. Do you want to pay it in a lump sum, or should we just increase your payment? And most people just have your payment increase until you catch up. Okay. In section F here, we've got an attorney fee that's $650 for this one. All of these other things are on the seller side. So this is the seller's column. And then we've got a summation of another 55, 45 and change. And you'll see that this total from ABC plus this total that's E, F, G, and H equals 11,171. But you'll see that this amount is your money going into your piggy bank for your own property tax in the future. This is your money going into escrow for the HOI, for the homeowners insurance. This amount is your money paying the policy premium. And this amount is, of course, the prepaid interest on the mortgage. So we've got about $4,800 worth of stuff that is in this number that isn't actually cost. This is in part being offset by the seller, like you're getting a closing cost tax proration for coverage of this number. So the point is, some of these fees, they're not really fees, they're not really costs. They're impounds for future bills, but they're not transactional costs. Like here or here, they're paying $134 to DuPage County for a service. They're not getting anything back out of it. You see the difference? So the closing cost box can be a little shocking to some, but that's how you think about it. It's like that's a percentage of this number is my own money, and some of that I'm going to get a credit for. Like down here, you'll see that there's a credit coming in. That's almost $5,800. That's offsetting this number. That's almost $2,900. So the seller is going to be providing some credit, and this is kind of where you look. This is the last section that I wanted to review, calculating cash to close. So this is kind of where we started. Let's get this up here. This is kind of where we started with the loan estimate up front. And then this is the prelim CD right here. So we'll see, this is where the earnest money is. And so initially we don't like to put that in, but now it's in, we've verified it. We've got the earnest money receipt. And so this was $5,000. And if you had a seller credit, in this case, there was a seller credit from the seller up front, it was on the contract. But if you negotiated during attorney and inspection and you have a closing cost credit from the seller, then it would show up here. If you don't see a number here on your CD, but you did receive a seller closing cost credit, that's a reason to reach out to me just to make sure that we have all the documentation and our closer has everything that they need. Because if you did get a closing cost credit, it should be here. Okay, this number is probably a conservative estimate of what the taxes will be, the tax proration, which is the credit from the seller to you, the buyer, to credit you for the taxes that are going into your escrow account up here. So that would show up right here, and it shows up one other place. And this would be your cash to close, that 38,774, which matches right here, 38,774. Okay. So that's page 2. All right. And then in page 3, actually the cash to close is on page 3. We can also see the tax prorations that are broken down here again, tax prorations are the taxes, the seller's side taxes that are crediting you for the taxes that are coming up in the next two bills, because those next two bills taxes are the sellers, right? Because in Illinois, we pay our taxes 1 year behind. So that means the seller's got to give you credit because the next two bills are theirs. It was for when they own the property, so they have to give you this credit. So anyway, that's in section L down here. We can review page 3.2 a little bit here. Section K has the sale price of the property, has some version of the closing costs, and section L has the deposit confirmed, has your earnest money confirmed. You'll see the seller credits here. You'll see the tax prorations are here, broken down from last year and this year and last year, right? And then you have the calculations at the bottom. And on the seller side, you've got the seller's side, and then some math on what's happening with the sale price, and the math going down to cash that's going to the seller between you, the buyer, and us, between your money and then the loan. So anyway, you can take a look at all of those things and make a determination on your own as to whether or not that is needing to be updated, but it probably is not. So on the last document page is page 4. Some of these things are relevant, some of these things aren't. So there's no assumptions on this loan, so you can't just like hand over the responsibility of paying the mortgage to somebody else. It says will not allow assumption. That's normal. Doesn't have a demand feature, which would require early repayment of the loan, so that's not allowed on this. There's some notes about in case you're late and how they do that. You'd have to be 30 days late for you to incur any sort of penalty on credit, but in the first 15 days, you've got a grace period. The next 15 days, you might get a late charge from your lender, but you're still good on credit. There's no negative amortization. In other words, you can't owe, like the loan balance can't grow against you. And they don't accept partial payments. So if your payment is, $3,000, you can't pay $2,100. You have to pay all $3,000. Otherwise, they will fully reject the payment. And you now have escrow. So this is confirming that there's escrow, and some other things. And let me see if there's anything else. The APR is here that captures the full transactional cost. So this interest rate was 6.5, but the APR is 6.7, kind of like when you buy an airline ticket and you've got the ticket price, but then you've got the taxes, you've got the bag fee, you've got the airport fee, you've got whatever else, and it actually totals something else. APR captures the entire transaction. The interest rate is the note rate. So when you look at the promissory note on your closing, it'll say 6.5% because that's what the run rate is on the loan amount. The APR just captures the total transaction. Okay. And then the total interest paid over 30 years is expressed as a very shocking percentage. It's really high. People don't usually stay in their loans for the entirety of 30 years. But some of these things are required. And basically, the other thing here is some obvious things. Liability after foreclosure. State law does not protect you from liability for the unpaid balance. In other words, pay your mortgage and you're all good. So anyway, this is the end of it. And I appreciate it. And if you have any questions specifically about your CD, please reach out. But this is how you review your own CD. I'll talk to you later.